tomorrow's a big day because it might just be our chance for a real narrative to build. And that is, of course, an old classic, a timeless investing bedtime fairy tale. The Fed put. I don't necessarily think it was the plan to have one this year. I'm not necessarily convinced that it's there because the economy hasn't deteriorated really enough. But I do think that when push comes to shove right now, the edge is towards an accommodative Fed and a little bit more of a dovish tone from Jerome Powell than probably he would prefer to strike. And some of that might be the implications of the new policy from Trump 2.0 and a pretty clearly directed policy that is affecting stocks and might affect bonds in the way that Trump 2.0 wants, which is lower yields. There's been a lot of quiet in the air between the president and the Fed chair. Despite a lot of rhetoric on the campaign trail, we haven't really heard much at all about Jerome Powell, and it seems like he is going to be able to do his job as he pleases. But the advent of the last 4 months, essentially, as we've seen the market start to price in some of the Trump 2.0 policy, is that Powell's decision-making now might have to include a stock market under pressure. Tech looks very heavy once again. The price action is not terribly encouraging. Today's session reflects the yellow light in stocks that I've got on the risk radar because we are chopping back and forth, and we held a pretty tight range today, which is good. We held a tight range, that's good. Even though we dropped off, it all happened overnight and early, basically within the first 30 minutes. We were done at the lows for the day by about 45 minutes into the session. However, right now we know that one way in which to slow the economy is to depress asset prices. This is a pretty fair thing to say. Household investment into equities is at an all-time high. We just had stocks at all-time highs. Everybody's been trading and investing since COVID. So if we do get downside in stocks, it does start to pinch the economy. And even though the economic data were deteriorating before the stock market fell apart, there is a sentiment element that is starting to show up in some of these numbers that I do think does reflect the stock market downside. And so right now, Jerome Powell's got a decision he's got to make, which is, does he stick with the data and be purely data dependent, or does he try to factor in what might be? Right now, the bond market is factoring in what might be pressure continued from tariffs, what might be continued nonchalant approach to seeing stocks come off. What is right now a big trade-off between us and the rest of the world with how we're spending money in the government, right? As we tighten things up with the DOGE program, the rest of the world suddenly starts getting all the equity flows as Germany expands their balance sheet, et cetera. So all this complicates the picture for Jerome Powell, and that's why we've got a 70% chance of a cut in June right now. And that changed basically right as stocks came off. But there's a few things in the equation that don't quite line up for me right now, which makes tomorrow interesting. One is the dollar next to the 10-year yield. 10-year yields have been calm. 10-year yields held 4.2, and they've been chopping back and forth. The dollar's been incessant in its downside. To me, that's a gap you can see that doesn't last for very long. Either closes yields to the downside or dollar to the upside, but I'm still thinking it probably closes dollar to the upside because you have to remember one very important fact going into tomorrow and for the rest of the year when you're thinking about the Fed. This is a really important reminder, and you might have forgot about it because we've been so busy talking about the sell-off, we've been so busy talking about tariffs, and that is that when the Fed started cutting last year, that was the low. That was the low. It's the most important thing because somehow today I still hear people continuing to discuss the Fed cuts and an easy path from the Fed as being something that drives yields lower. That is only going to be the case if we do have continued stock market downside, if we have weakening in the economy. Otherwise, if the Fed sounds cool-headed here, which they're probably going to do, that's going to equate to basically dovish. And as the Fed gets incrementally dovish, we've seen that that's actually led to higher yields last year. As they were cutting, yields went up. And that would make sense right now for a bounce for bulls because if Powell sounds dovish and calm and that makes yields go up, and we know that stocks have recorrelated with yields to the upside, that's probably what you're rooting for tomorrow, which is a dovish Powell that actually makes bonds sell off a little bit, maybe the dollar firm, and then we'll see what stocks do.